Well, good afternoon. Good afternoon and welcome to another of our Managing Your Small Business Beyond the Pandemic series. This is number 126, going back to March of 2020. And overall, let's see, this is webinar number 241, going back to 2013. So good afternoon, I'm Kelly Bearden. I'm the host and I'm your director of the California State University Bakersfield Small Business Development Center. And we are part of America's Small Business Development Center program in all 50 states. So what's up today? Today we're up to August the 10th, 2022. So our capital quarter today is going to take a deep dive, a deep look into what is happening in equity funding. So when we talk about equity funding, we're talking about kind of the old school term of equity, although the new school term might pop in with a couple of programs today, but the old school equity term of basically your balance sheet side of your credit side of your balance sheet with your debt and equity and ways to fund a particular business and more or less capitalize that business will be our main topic today. Before we get there, we'll jump in a little bit to the economic corner, take a quick look on inflation, and we'll also talk a little bit about the drop today in inflation and what that potentially means, and maybe also what it means for trying to raise capital in this environment. Maureen is back with our marketing moment with our marketing maven Maureen, and she's going to have a little marketing tip for us. We have Idle back in the news, and I'll get into this probably more next week, but there is a lot of things happening on the Idle front. I'll just give you a quick synopsis right now. One is a number of loans that had the deferrals are going to be coming due as far as starting their payment cycle. SBA recently, and thanks to our listener Susie for this, providing me with the recent copy of the Senate Entrepreneurship Committee hearing meeting recently. I kind of got out of the habit of going to those without all the federal programs to keep up on. But SBA was on and reported that nearly 1/3 of SBA EIDL recipients, that's the COVID EIDL, have started already repaying their EIDLs. So there's a lot of other things that came out of that we'll talk about next week, but just keep an eye out. If you do have an EIDL, look for that payment that's going to probably could become due as soon as the next couple of months. And those are going to be for those that were made early in the pandemic in March, April of 2020. The other thing that SBA said that I just want to caution and advise some of you out there is that they have still 125,000 EIDLs that have been approved and ready to fund. They just need the borrower to close. So I realize some people probably took out the EIDL loan and realized that it's a loan and it needs to be repaid. And even though the great terms of 3.75% over 30 years is money we might not ever see again, they might not have had a need for that and didn't follow up. But I gotta believe also that there's also those individuals that are out there that did not, for whatever reason, find a way to close their particular loan. So you do have to file there is work like closing any other loan. There's a loan agreement and arrangement that has to be the LLA that has to be signed and brought back to SBA. And also there's the formal process of collateralizing with whatever form of collateral based on the size of the loan, anything from a UCC1 filing on your assets to also SBA taking some collateral on, say, real property for your larger EIDLs. So anyway, just keep that in mind that there are still a number of individuals who have not closed, and maybe there has been issues going back and forth on communication. So if you were ever approved or know somebody that was approved and still wants those EIDL funds, they can still close those loans. So we'll also give a quick update on the remaining programs that are kind of hanging around that are still out there. And as always, have your questions today. We've got a great expert I'm getting ready to introduce and bring in today. And so have your questions, and we'll start with a poll. So let's see, simple questions, and then maybe we'll go a little whimsical on it. So talking about equity capital, the first question, our first poll question today is going to be very simply, are you or do you know somebody looking for equity type funding? So it's the investment funding. It's usually given up form of form of ownership in your business in order to bring in capital and grow that business. So we're looking to see, yes, are you just looking for information? Maybe it's something you'll use later down the road. Maybe you need it now for a friend, or no, maybe it's later down the road or whatever. Or potentially maybe if we just hit you with the right terms, the right deal, the right program, the right situation today, you have a project that'll roll. So we'll give you just another couple of moments to select either yes or no to you or somebody looking at equity type financing. We have 75% of you participating. So we're going to jump in at 79% and in the poll. And we have a dead heat between yes and no. Basically, 37% yes, 37% no, and a 26% maybe. So between the yeses and the maybes, almost 2/3 of you are either looking or know somebody who is looking potentially. So there we go right there. Yes, no, maybe. 37 and 26. Okay, poll question number 2. So let me stop that share, go back to our polls and go back to poll question number 2. And let's see, poll question number 2. I know you're out there trying to hide from me today, but you can't do it. So what equity source are you looking for? So for those of you that said yes, what equity source are you looking for? Are you looking for some type of private equity, venture capital, angel investing, or others? And if you're looking for some type of other capital source, go into the chat and please identify that, and we'll come back and circle back to that later on. So not a lot of choices here, but there's a big broad other in a chat box for you. Private equity, venture capital, angel investing, or other. So rather specific, and hey, maybe you're here to learn more about those topics today rather than for us to throw it out at the beginning. Maybe a better poll question toward the end. But equity sources you're looking for, and we'll give you just another moment and 2 in there, and we're going to end the poll, and it's perfectly evenly divided. Look at that. 40% of you, as we share the results, are looking at angel form of funding. 30% have others, so you can go to that wonderful chat box and put that in there if you so desire. 20% some form or another of private equity, and 10% venture capital. So thank you for participating. Okay, 1 more or 2 more. Let's let's have a little fun with one right now. So and dealing with inflation that we'll be talking about in a moment. We've talked a lot about inflation and it's out there. So we're going to launch this poll. The Motel 6 chain began 60 years ago in 1962, renting rooms. So if you were to adjust today to inflation, because they charged $6 a room in 1962. So if you take that $6 by $22, how much would that be? Would it be 30? Would it be 60, or would it be $90? So very roughly, no, actually it's very precise, slightly rough. I'm $1 off on the amount, that's the correct number. So Motel 6 rented rooms 60 years ago for $6. How much would that be nowadays? Would it be 30, 60, or $90? So 30 would be a 5-fold increase over 60 years. 60 would be a 10-fold increase, and a 15 times increase in the time for that price over the last 60 years. Okay, 66% of you are playing along with us today. And we are going to end the poll about right now. So here we go. And share the results with you. And 72% of you said $90. And 22% of you said $60, and the correct answer is $60. So basically a 10-fold increase in prices. If you really want to look at inflation over 60 years, it's been a 10-fold increase. Okay, so there's a little inflation, and while we're on the Motel 6 theme, not where actually I stayed last night, but going through a little bit of a issue here, but here we go with the next question. And that will be essentially how much is the average room rate at the most expensive Motel 6? Okay. Is it $199, $329, or $449? This is the, and I'll even give you a backstory behind it. It's located where the chain began, just 100 miles south of us in Santa Barbara. It is their original location that they sold to another party just recently in the last year. And it has been redone, and it is in an extremely nice location. Steps to the beach, center of everywhere, Motel 6. So what we're going to do is we're going to end the poll with 55% of you participating. Last chance to get in. And we're going to share the results with you. And the most expensive Motel 6 is $449, and they sell out all 60 rooms, it seems like, almost all the time. So there you go. 21% of you got that right. Hotels are expensive these days, it seems like, and Motel 6 is no exception in some cases. Okay, thank you all for participating. Let's jump into the key action steps and programs that are going on. The California Performing Arts Grant is open. It opened 4 weeks ago. You could see Lindustry, or actually Maureen in the chat box will provide you with more information. But the California Performing Arts Grant is open to nonprofits on a first come, first served basis. So it's really something you're going to really want to move the needle on. If you know somebody who might qualify, might be eligible as a nonprofit for this Performing Arts Grant. The California Dream Fund, if you are interested in it, just real quickly on the California Dream Fund, send information to our email. If you're anywhere in these 14 county regions of Central California. We had a update yesterday. I believe we were somewhere around 135 individuals who have contacted to go through the process. We still have space available. The next training, I believe, is happening in October. A couple are going on now, but they are full. And again, what you do is you receive $5,000 and sometimes $10,000 for completing training, a business plan, and technical assistance. You have to meet a lot of different issues. And really, this $5,000 is a lot of work, okay? Every type of funding is going to be a lot of work, no matter what you get. You can go to a GoFundMe account. You can go to a crowdfunding Kickstarter account. They're going to be a lot of work. So if you're doing it for the $5,000, do it because you really want to kickstart a business, and $5,000 would really do that. Do it because you really want to get some good training and set that foundation for your particular business. Do that because you want to write a great business plan and you want to follow it and meet with one of our fine SBDC technical assistance advisors and have them work with you on getting the business off to a good start. Don't do it for the $5,000. The $5,000 is nice though. So, and again, entry into the training program does not guarantee funding in that particular program. So looking for people new to entrepreneurship. It is not for existing businesses. It is those for who are starting a business, wanting to start. Many of those are individuals have been disadvantaged and have had barriers to starting businesses. So please, if you're interested, we'd love to work with you. So also, in addition to that, the state small business credit initiative is really kind of an interesting, and it's not really coming out until probably around the 1st of October. So we've got time to get into a little bit more of that as the next weeks go on. It's still at the US Treasury, the $1.1 billion that's going to be coming to California in a variety of different means. One of them will be a underserved venture capital component, what I believe is going to be $150 million or so. So we're going to be very interested to find out what is happening with that particular program. And we'll know more probably about the first part of October, so stay tuned. The California Micro Grant Program in Kern County is open, $2,500 grants for micro businesses with sales of less than $50,000 in 2019. Several other conditions apply, so please read the eligibilities, and if you're eligible and have not received the California Relief Grant through Lindustry.com, apply. Please don't apply under other situations. The Mono County Grant and Forgivable Loan Program is open. It is open in Mono County. You're going to want to see one of the Jeffs, Jeff Simpson, the Economic Development Manager, or also Jeff Lucas, who is their consultant for the program. It is still open. They're taking applications, but they do have some loans in the queue. So don't expect it to be an overnight program. The employee retention credit is open from the standpoint as they're accepting retroactive amended filings up to the tax year September 30th, 2021. A lot of employers have really taken advantage of this and have really worked it with a lot of their other relief programs to take advantage. The retention credit, it's a tax credit from the federal government, but it also can be taken in the form of cash and be taken in advance. So it is something that is just not going to save your taxes in the next 3 years. It's something that could save your business now in some situations. The CalSavers mandated employee employment program, CalSavers, is open for those that have 5 employees or more. You are mandated by July 1 to have signed up for this program. Don't let the heavy hand of Sacramento start weighing down on you. If you have more than 5 employees, make sure you are signed up to CalSavers. We hit on the Dream Fund a little bit in the Cal Micro Grant Program in California. Now, let's jump to Maureen and go to our marketing moment with our marketing maven, Maureen. Maureen, thank you for joining us from the mothership.
Hi, Kelly. Let's see here. Let's get going. So I thought we'd do something fun today. I always like to go out and find examples of successful campaigns out there. And this one's Twix. Who doesn't love Twix, right? So this is their website. If you want to go out there, it's real hard to find, twix.com. And one of the things, I've done a lot of work this month with some of our SBDC clients on, they've been putting websites together. And one of the things I like with this is how simple it looks. It's clean. They have, who knew they had recipes for Twix, right? Man, it was, when I was looking at it, it made my teeth just about rot in my head with all the sugar in it. Anyway, all right. So one of the things that they've come up with is they had a campaign, a marketing campaign called the Twix Meltdown. And if you can look at, can you see, Kelly, what those things in the middle look like? Are you with me?
Yes.
Okay, good. Anyway, so it's where you could put them into your coffee for, you had to have instructions on it, right? So you put it in there, you insert that into your coffee cup, you put your Twix in there, and then voila, depending on which of the 2 Twix you like, you would have coffee with that. And then you can just eat the cookie part of it. Anyway, so what they did was, this was a proprietary device. And what they like to do is to do things that are fun, right? With people who are their, fans. So however, like most things in life, there was, of course, a catch. This device was a limited edition. So, right, it's like planned obsolescence. One of the things we marketers are really known for, and I cuss people out like that too, like batteries, right, Iris? Anyway, so in order to get your hands on one of these gems, you had to follow Twix on Instagram, and I checked it out. They're up to, I don't know, a little bit south of 1 million, but I think it was like 900,000 on Instagram. And then wait for the official competition rules. And so this delayed gratification was an effective way to drive up engagement, excite consumers, and showcase the versatility of the much loved chocolate bar. So here's the thing. I go out there and I'm trying to find, I'm Googling, what those rules were, so, how to get it. They were putting all this kinds of stuff up there with those pictures on Facebook, Twitter, Instagram, the whole schmerola. And it was a sweepstakes. So help me. I went around, we see the sweepstakes there where it's a hot link and you can go to it. It took me to Facebook to where then it said whatever was there is gone. It just said I had no permission to try to do anything with it. I could never find the actual rules. However, mind you, this was a 2019 campaign.
She only has 3 minutes. I don't even know.
I can hear you, Kelly. Anyway, so here's what I found out there was that they did this same type of a thing with the Twix cookie dough, and where it's a sweepstakes. So the primary takeaway on all this in here, what did they want from people other than they were trying to get engagement going here, is they wanted your email. You had to wait until they put this out there. Now this is just from last month, okay, because there was a National Cookie Day. That's how they were celebrating it. So you had to give them their email. You had to follow their directions on, when to jump in. And they had 1,000 boxes that would have 4 single bars of Twix. Okay, so here's what happened. It took less than, so if you look over here where it says, Sweetie says, due to high volume of interest, all samples of Twix cookie dough were snapped up in less than 3 minutes. We'll be giving away a few extra boxes on our social media channel over the new few days. Now, Phil here, our buddy Phil, he's in here where he's been trying for God knows how long, and what a waste of time. He'd been trying for 40 minutes, then he tried getting back on again. And then he finally got his Twix, where he said it was an awful lot of work for 4 bars. The thing is, what happens, like we've all seen where people get not great reviews. So Sweetie here, who represents Twix, did the right thing, which is she jumped in there and, let everybody know that there was hope, right? So it kind of perpetuated it. And then Phil got his, bars, but they continue to do these kind of things, and you can find this stuff on their website if you want to go take a look. And I'm turning it back to you.
But now let me bring in, before I have another glitch, our distinguished guest speaker today, and that's going to be Kurt Friedmann, who's an experienced entrepreneur, sales leaderboard member, 20-year history of working in high growth companies, all stages from an initial startup stage all the way through the end. An advisor investor to over 250 startup businesses. That's right. I used the slide from when he was here last time, about 95 weeks ago. He's now actually invested in over 250 startup businesses, co-founder of nonprofit entities, mentoring to over 50,000 students through 3,000 mentors in 11 countries worldwide. He's great in the lean startup, sales management, negotiations, a lot of other things, business finance, a strong development and consulting professional, graduated in business finance from California Polytechnic State University, San Luis Obispo. It's harder to say when you just don't say Cal Poly, but that business finance degree from a state university, California State University, those are golden. Share one myself. So thank you for sticking around. Thank you, Kurt, for being here. It's great to have you. We're going to just jump into this next slide and let you take it away right after we talk about this inflation corner right here. And what I want to do is just jump from, we saw where inflation was down today, and we have a lot of issues going on with the economy. And we want to see how and get your opinion on how that relates to raising funds in this economic environment. So we have productivity that has been decreasing, which means employers are paying more for less production, which means they either have to make less money or raise their prices. We saw inflation dip to 8.5 on an annual level, which was good news. I think it was kind of expected because what we've seen at the gas pump, we're paying $1 less than we did last month. So inflation dropped, and that's despite wage gains, because wages are continuing to be very strong, competition for employees and workers. And so the Fed's next move, all this is factoring into what is going on to investors and what projects they want to fund, what they want to do with their money, where they see this all going. So Kurt, it's great to have you in here.
Hey, great to be here. Thanks, Kelly. And that finance degree from Cal Poly was a long time ago, but I'm still here in San Luis and happy to be here. So.
Okay, so what are you seeing right now in this current environment? Is anything really changed in the last 6 months when we started this economic environment of economic downturn, potential recession, inflation, all this stuff?
Yeah, I would say that it has changed or certainly accelerated. So, we have to remember that the VC and private equity and funding markets that we're all interested in here today, they follow the public equity market pretty closely. And, as we've seen the deterioration in stocks and public equities, we're also seeing money scale back in private equity and venture funding. And so I think we're down, if we look at VC funding, we're down somewhere in the neighborhood of about 30%. But that still leaves a lot of money available. But it is, there's two things that are going on. One is that there is less money available. And the other important thing is that valuations, what you get and the valuation that you get for your company when you're funded definitely have taken a hit as well. But it does not mean by any stretch of the imagination that funding has dried up. It has not. There's still a lot of money out there. It's just that as business owners, you've got to adjust your expectations and be a little more creative. But there's still money out there.
Hey, great. So let's start going through a lot of the different programs that are out there. So get everything situated here. Ooh. So let's start off with VC, with venture capital. I know you've worked with a lot of companies, venture capital. Talk about a little bit what you see out there now and what you see and what you hope to see in the future.
Well, it's tough in the VC space. And the reason for that is that, venture capital is looking for growth. They're looking for high growth companies. And, not a ton of them need to pay off, but the ones that do need to pay off handsomely. And there's risk. There's a lot of risk in that right now. And for all the reasons, Kelly, that you mentioned, we've got lower productivity, both financially and on the employee side. It's a little bit harder to do things. Inflation is cutting into some of that as well. And so the growth aspects for companies that venture capitalists would put their money into just aren't there to justify the risk that they would need to take for the valuations. And the type of money that is in venture capital, again, it's moonshot money. It's looking for investments that are going to be massive, high growth. And that's just not what we're seeing. We're not seeing it in the public equity markets right now. And we're certainly not seeing it in the venture capital markets. That being said, these venture firms have partners, limited partners, and other partners that have put their money, that want their money put to work. And so that money is still out there. There's just less of it around and at lower valuation rates.
So can you give any specifics of what you're seeing with individual clients? Obviously, we don't want you to mention the clients,
Right.
But just some kind of generalities and some things that maybe they're going to do differently now with this environment, or maybe even something that they hope to work just through over time.
Sure. So, venture capitalists are really looking for, again, high growth companies. But when you've got a high growth company like that, maybe your business model hasn't changed at all. Maybe your revenues haven't changed. So, and maybe they've even gone up. Maybe you're in a better position today. But that's a tough thing to have happen when you're a founder. And last year you were going to get in a very successful maybe SaaS business or something like that. Let's say you were going to get double-digit valuation, 10, 12, 17 on your valuation. Getting a big haircut on that valuation is hard to swallow. And so you tend to lay back unless you really, really, really have to have the money. And instead you cut costs and gut it out for a little bit till you can get the valuation that you want. All that means is no deal.
No deal. So you probably see a lot of deals that go the angel investment route.
Yeah.
Can you comment on and maybe tell how one of those typical deals works?
Yeah, I mean, angel investment is right at the very beginning of the investment cycle. Typically, a little bit less sophisticated investor, certainly than a VC or growth equity investor. And it's very, very much about the relationship and your ability to be able to tell that story to that angel investor. So there's still angel investment money out there. It's hard for investors to find a place to put their money where they can find growth. And a good story still works in the angel investing space. The key is, where do you find those? And that really comes into where your network comes into play. And that's why I like sending companies to the SBDC, because they've got tentacles out there and a good network to be able to tap into some of those angel investors.
Are you an angel investor yourself?
I am, yeah. Between my wife and I, we probably invested in, gosh, over the years, a dozen or so different companies at various stages.
What's your best success story?
Oh gosh, some great exits, and also a number that are still hopeful, and a few that fizzled out and just didn't happen. So but some really fun successes, and really enjoy working with the team.
Yeah, and that's kind of the nature of it, because out of every 10 deals that is funded by an angel investment group, what is the total of those that actually have a successful ending?
Yeah, it depends upon what you mean by success, but
Probably getting your money back.
I mean, I feel super fortunate that we've been pretty successful, but in most of those business, well, let me answer your question first. 2 out of 10 in that area, depending upon what your definition of success is. Where I see success as an investor is when I get involved with the companies. So I'm willing to put some time in, and in some cases even work alongside some of those investors, so that I know what's going on, and I can help and provide some resources.
Great.
And that's what you get with an angel investor. In some cases, they'll be completely silent, and in some cases, they're really bought into your story and want to be part of that story and part of the success.
Yeah, a great program that you have locally here at the Cal Poly SBDC CIE is you have an angel conference. It's now been going on for 4 or 5 years, and it seems to be a wonderful jumpstart tool for angel investors, but also for the small businesses. Have you worked with businesses in that program?
I've worked with businesses in the program, try to get them ready for the angel conference, we call it Angel Con. And then I've been an investor myself, I think, in the very first one. And it's a fun process. As an investor, you get to work and do diligence with other investors. You get to see, a number of different companies, and the camaraderie between investors and teams is just a lot of fun. Phenomenal experience for both investors, angel investors, and startups. Great program.
What about small business investment companies? Small business investment companies are traditionally funded by SBA. I know that there's been a lot of review going on exactly how successful they are, and maybe ways how they can make them stronger and make them more innovative. Seems like a lot of times they're larger funds that get either guarantees or government SBA funds, and then they invest those. Have you worked with any companies who have ever been able to access small business investment companies?
I have not done any deals personally with the SBICs, and I don't have a lot of experience with those. I think it's likely a good route, because you've got, there's guarantees behind it, which allows the SBICs to take more risk in some cases, and be able to fund projects that might not otherwise be funded. It will be interesting to see where those go in terms of the growth of those programs. But I'm not seeing a ton of those in the marketplace. Doesn't mean they don't exist. I just haven't come across them as much.
Well, another federal government program, the SBIR program, the Small Business Innovative Research Grant. I know in our Central California region, generally when we have successful SBIRs, even though there's $3.9 billion nationwide that's being put out into startup companies, non-diluted, so you keep 100% of the ownership, which is really one of the nice features behind that. But they're happening here in San Luis Obispo County. So have you had a chance to work with some of those?
A number of them, and this is a fantastic program. I mean, this is, there's not many free lunches out there, but this is one of them. The SBIR grants are a fantastic way to go, because Kelly, as you mentioned, it's grant money. I mean, that's free money, and there's a lot of incentive to back businesses that do something for for the public good. So I really like the SBIR grants. It's a great way to be able to get funding for your entity, and as well, and to go through a discipline program in order to be able to get that grant, and then you're not having to give up equity or debt.
You know, really one of the programs that I thought was going to have great success was going to be equity crowdfunding.
Yeah, we all did.
And whereas I haven't given up, I still believe that it might make it. It's off to a rather slow start. And I know that there's been challenges, and I think really it's a lot of it is just educating individuals on what it is and how it works and how it would benefit them. But have you had any success? Have you had any dealings, pro or con, with equity type crowdfunding or other form crowdfunding?
Early on, when equity crowdfunding was just getting started, did have some success with that. But yeah, like you say, it's I'm almost forgotten about it as a investment device and as a funding medium. I just don't see much of it in my sphere. Doesn't mean that it doesn't exist. Doesn't mean that it's not a potentially good route. I just don't come across it as much anymore. There's some complications. It's in some cases it can be difficult to understand, and things that aren't simple just have a difficult time. But I would certainly encourage you to go out and check it out. Maybe it's something that I need to go back out and check out as well. But I don't come across it very often.
What about other forms of crowdfunding? Seems like you work with a lot of companies that are product-based. So product-based, you have that opportunity for donation crowdfunding, Kickstarter, such.
Yes.
Any success there?
Some success for sure. And the more consumer focused your product is, and the more that somebody and the more easily understandable it is, the better you're going to do in those kind of crowdfunded mediums. Still working there. I tend to be able to as a startup, to be able to try to cultivate some of your own channel and your own interest level, but through other means. But the whole idea is to be able to get an audience, and crowdfunding is certainly a way to do it if they can understand your business.
I think the next dot is one of my favorites. It's one that's really not utilized a lot, starting with strategic partnerships. Maybe because I had a project quite a few years ago that was really a classic strategic partnership, where you had basically a funder who actually was the seller back to the material for the business. And since they sold them a third of their business, they wanted to keep them in business. And so they would fund an acquisition when the business was sold to keep them going. And it was kind of a unique relationship where it was a strategic partnership. It was keep them in business so we don't lose a customer that's generating a third of our business. So along those lines, and also joint ventures, and then other forms of partnerships, limited partnerships, anything stands out with those three?
I love strategic partnerships. And one of the reasons I've had success with them myself. I've been involved in 3 different ventures that were strategic partnerships. When we talk about a strategic partnership, like Kelly mentioned, it's that the entity that's investing in you sees you as a strategic part of their business and wants to be able to provide guidance and have some control over that, because they see it affecting their business down the road. That is a great relationship. Valuations can be higher, can be much higher, and you get the expertise, support, channels, marketing, administrative support that you need from an entity that would be much larger than yourself. We only get so many successes as startup owners, and strategic partnerships are a phenomenal way to go, in my opinion. Every investor, every startup should be looking at, where is my exit? What are the companies that would have a strategic interest in my customer base or acquiring? And those are really good ones to get relationships with, regardless of whether they end up investing or not.
Yeah, I think it also works well in lower tech. It works, I think, all across the board with businesses.
Yep.
And one thing that I remember a story from a client a few years back also, where she actually would do a strategic partnership, a very, very low tech strategic partnership where she would put on and produce this 100-booth Thanksgiving craft fair, Thanksgiving weekend craft fair. And a lot of the people that she wanted would say, I can't build enough material, I don't have the cost. And she would loan the money before the event. And then after the event, they would pay her back. It's that simple. It can be as creative as any way you make it. It can be as simple and as difficult and creative for any way, shape, or form.
That's why I really like, and it's a great way to take a look at it, Kelly, is take it down to the most base level, up to very, very high level strategic partnerships. There's something in a strategic partnership for just about any business, and I just think it's a fantastic way to go, and tends to be a little bit more non-traditional but extremely effective.
And every business has customers, vendors. They have loyal followers, and they have a lot of others that strategically want them to succeed. So acquisitions and any mezzanine funding, and maybe you can even define mezzanine funding for me.
I can't. I really the acquisition strategy. I can definitely.
You do that. I'll take on.
Okay, I've been involved in 6 acquisitions, and acquisitions are fantastic. It's they often happen because of a strategic partnership in one way or another, whether that was a financial strategic partnership or a marketing strategic partnership or some type of product strategic partnership. Acquisitions happen as a result of those two parties being able to get value out of each other. Also being the smaller player and being bought out of the market to avoid competition, or if you've got some type of innovation, great strategy in order to be acquired. And Kelly, I'll let you take the mezzanine funding.
Well, mezzanine funding, if you look at the startups that you work with in 4 phases, you have like a startup phase, and then you have an early phase funding. And mezzanine funding I always looked at was like my old famous JC Penney that was on 3 levels, and they had the mezzanine level. So it's that middle type of funding that is there before you get to your ultimate goal of a successful indie. So that successful completion can be, selling the business. It could be actually an IPO or some other ways, or initial public offering, or doing something to get you to that point. So it's that part that's past the startup and the early stage funding, but not till you get your big funding shot. So that's how I've always seen it. And I've only seen it a few times, so we'd like to see it more. Private placement, IPO, mini IPO, and just in case you have any more acquisitions.
Yeah, so I'll talk more about private placement because that's probably more along the lines of what might appeal to the audience.
First, define it.
Yeah, so private money is money that's coming in from private and individual investors, family funds, all kinds of things. There are growth equity companies that go ahead and have a syndicate of money that they put together. That money comes sometimes from wealthy individuals, family funds, institutions, but these private equity investors are different than a typical venture capital entity in that they want to be able to, usually have a little bit longer time horizon. They favor bootstrap companies. They really like to find companies that have been able to make some profit on or at least keep going on a small niche marketplace. And they want to see companies that have been able to, really just bootstrap it together and be able to invest the money that they make back into the company. And so you've got 2 different types, at least that I work a lot with in the private placement area, and that would be growth equity that are really more focused, that kind of sit halfway between a venture capital and a regular private equity firm. And they're looking for more growth, but they want to participate a little bit. They've got resources, they've got resources in addition to money. They've got connections, they've done this before themselves, and they want to be able to lend a hand. they can either take a minority interest in your company, or they can take a majority interest in your company. And there's advantages and disadvantages to both of those. And then you've got the traditional private equity firms that are either looking for the same thing, but different risk and time horizons.
So we actually did talk about bootstrapping a little bit, because it can go on a very, very small business that's not going to scale like the businesses you work with. But it has an incredible value for those that are able to retain ownership as they grow that business to where they retain ownership more as they get down the road toward ultimately finding the actual value of that company.
Yeah, I'm glad you saved this one for near last, because if you can bootstrap your company, you're in the best place of all, in my opinion. So how do you do that? You know, the key is to be able to look at a very small portion of an otherwise growing market, and be able to go in and produce a minimum viable product that a few people will want and pay for. And then once you have that toehold, to be able to, you know, use the funding that you use the money that the profits of the company to keep growing your company and expanding. Investors, private equity and growth equity companies really like bootstrap companies, because they've already proven that they know how to manage their business and they know how to internally grow their business. You end up it's a much safer bet, in my opinion, both for the investor and for the company than the venture capital route. But it's not. There's some solutions and some markets that you just can't bootstrap. The financing costs are just too great.
And bootstrapping from a Main Street business perspective is just getting as little debt as you can, or getting your friends and family behind you and running with it. And just trying to save as much money as you can and plow it back in. And I see individuals that do this, and they make incredible sacrifices in their standard of living. They do whatever they can and plow whatever they can back into that business, because they know if they can get that toehold, as you called it. I like that. I'm going to steal that one. If they can get that in for 2 to 3 years and start building market share, build a business, then they have something that's going to last them for a considerable time.
Yeah, that's the type of entities that I like to put my money into, are bootstrap companies. They're a safer bet. They've got I guess it would be the Warren Buffett of startup investing, is you go to bootstrap companies, because they're the ones who have the discipline, they're very scrappy. You got to be extremely scrappy, get money from wherever you can, and be very careful about the way that you spend it.
I've never seen royalty financing. You?
No.
I keep looking. You know, there's just a few of these on here that I never see, and I want to see one of those deals before I hang it up. So anyway, one thing that we don't have on here is, when we're talking about equity, is we're not talking about debt. And so just quickly, let's finish up on debt and what you're seeing as far as debt for startup businesses, and ways that they can borrow, and programs maybe they're utilizing, and maybe some systems that are out there for them.
Yeah, and we really did overlook debt financing, and there's all kinds of government programs, and bank programs, and then private debt programs as well. I mean, not everything that involves raising money means that you need to give away a share of the company, and when you don't, that's what we call debt financing. And you can get as creative as you want with debt financing. Basically, it's just a loan to your business in one form or another. That may need to be secured. It may not need to be secured. But the great thing about it is it gives you money to grow, as long as you can grow your profits faster than the rate at which you have to pay it back. You're in good shape. But if you've got a good company and you can actually make profit, debt financing is just a great way to go.
Yeah, and it's one thing that I think that we really want to leave with people today is that there are creative solutions on the equity side and there's creative solutions on the debt side. It really, ideas that we've never even seen could be in your head right now as far as creatively, it's just got to make sense. It's got to make sense not only for you, but obviously whoever's going to be lending that debt or providing that equity.
Yeah, I agree. And in any of these, no matter what you do, whether it's debt or equity, I just can't, as an investor, I can't stress highly enough to be able to really spend a lot of time to really be able to know your market, and really be able to know your customer, and be able to prove to an investor that you've got a way of being able to tap that market with your solution. The sad truth is that while there's so many different ways of being able to get money, it never comes easily enough. And the more that you can do to prepare yourself to have these investor conversations, the better your chances are going to be able to actually get that money. And I'm talking about from an investor perspective right now. But yeah, a good solid business with a great great business plan and great customers, or at least a great market that's expanding is there's nothing more attractive than that.
Okay, well, let's jump into the questions right now. And let's see, the first one is, what is meant by wages growth and wages going strong? Everybody I know can find work, but it's temporary with no benefits, no guarantees, and because one usually has to pay. Well, I usually the information that we provide there is on a national level, but I think it pretty much translates down to our area. I think it reflects what's happening in Central California. So I think by those reports that are coming in, is they're showing that wages are strong from the standpoint that they're continuing to grow. And there is demand for employees out there. There's a lot of places that need a lot of help. If you look around, there's lots of businesses. So I would just kind of continue to go from that standpoint, that as supply and demand, employees are in demand as a general level. And so as long as they're in demand, they're going to require and request more funds to get paid, et cetera.
Yeah, and I can see that as working within a business, the business that I work with at Land Gorilla, which is where I'm the chief strategy officer. Yeah, we have strong pressure right now to up wages, and to it's still difficult to find the right talent, and because of inflation, and other things going on, we're having to increase wages. And that means that we also have to increase prices. So I would say that there's still strong wage pressure.
Okay, also we have the next question is going to be based on, do strategic partners or partnerships create a small business enterprise disadvantaged business enterprise conflict? So I guess that's along the route of government contracting, and I think you can have pretty much a conflict of interest in anything that you do, but I would say that you can create strategic partnerships in a, and I'm looking at this from the standpoint of how I think it's intended as a government procurement, government contracting type of question. So it would be between the small business and also maybe the contractor. I would think that just because if there's a preference given to small businesses in government contracting situations, that I don't see that would specifically create a conflict of interest or a conflict that maybe another possibly could. Okay, last call for questions. And okay, so next week we will be back, and hopefully Zoom will cooperate with me. I'm assuming it will. We'll be back with Stephanie Seaver. She's the CEO of Alta One Credit Union, and they have recently been named a CDFI, a Community Development Financial Institution. So the financial talk is going to continue next week with Stephanie Sievers. We'll be in Ridgecrest, California. at home of Alta One Credit Union. So any final comments, Kurt, before we wrap up?
No, I just, again, always take my hat off to all the entrepreneurs out there. It takes a lot of guts to do what you're doing, and I really salute you.
I agree wholeheartedly, and we don't say that enough, so I'm glad you mentioned it. Okay, well, for Kurt Friedmann, I'm Kelly Bearden. We'll be back next week, everybody. Everybody have a great week. We'll see you then. Bye-bye, everyone.